Okay, folks, we're going to get started. If everyone could grab a seat, grab a drink, get comfortable. Kerry, if you can grab everyone out back, that'd be great. So we're about to start the second and essentially final segment. Jody Mueller will say a few words after the end of this. But we're going to, our panelists are in front of us. So we've got Catherine Legraw. Catherine? Catherine? Hi. Hi there. How you doing? Catherine is from a firm called GMO, and it's not like in your food, no GMOs. It's not any of that stuff, right? And Catherine's got she's with that firm, and she's with their asset allocation committee. So conceptually, she can look at any asset class in the world and determine whether she thinks it's a good one, a bad one. Do we want to put it in the portfolio or not? So she's pretty freewheeling in terms of what she's doing. She can describe better than me. Steve Cucchiaro. So Steve, I have to say, we went to lunch maybe a month ago. And I got back from lunch, and I was talking to my partner Chris about Steve Cucchiaro. I said, "Oh, Steve, he had a couple of tech companies. He sold, made a ton of money. He started to manage his own money, then started Windward, which is grew to about $4 billion, sold to Schwab, and now he's doing this." And the conversation was great. So I was accused of having a man crush on you. So I just want to get that over with, clear the air right now. And I know Dave's feeling a little bad because I've been accused of having a man crush on you, but he's my new man crush over here. Well, we'll leave that to Glenn. Glenn will be there in a moment. So I think you're going to find, so we have different ends of the spectrum here. So Steve has a firm, and he don't like to use the word hedge fund, but he'll have separate accounts, and he'll manage money in a very proactive way with exchange-traded funds, and we'll look at indicators, and we'll be in and out of areas and sectors of the market probably more quickly than anyone else you're going to hear on this podium this evening. Okay, so we move towards Catherine, and GMO is famous for being a perma beer. They have that reputation. I'm not saying you guys are buzzkills, but a little bit of perma beer. But they're very analytic. It tends to have a very, very high valuation bias in a lot of things. So if things look really cheap, the cheaper it gets, it means the worse it's done. They get really excited. The rest of us, maybe not so much. So then we move over to Dave Morton. Dave is the chief strategist for Rokaton, and as you folks all know, I think you know that Lexington Wealth, our investment committee, has hired Rokaton to help us with analysis and global thought process in and around markets and investments. David's been here many times in the past. I would say he may be the smartest guy here because he has a British accent. So it's just, you get 50 points of IQ.
30 years I don't sound so British.
Well, compared to my Boston accent, you're doing pretty good. So their view of the world is he's a strategist, and they're a research group out of Norwalk, Connecticut. They advise on about $600 billion of money. A lot of it's institutional money, and some not so much. But they're global thinkers. They don't manage any end money. They're looking at building portfolios that will work over time periods. They're looking at up markets, down market protection, and they're really concerned and thinking about things from that lens. Someone like Steve could be, or GMO could be a raw material that could be used in one of their portfolios. And then we kind of come to the top of the pyramid, tip of the spear, Glenn Frank, Professor Glenn. And Glenn is a key player at Lexington. He's been doing this for a long time. He was my professor at one point at Bentley College, when it was Bentley College, not Bentley University. And Glenn comes with a whole host of backgrounds, tax being one, but he's been on different investment committees and been doing this for years. And Glenn's perspective will be that representing that of the client. You can have all these great thoughts and ideas, but how do we put it into a portfolio? How does it work for you and your family? How does it help get you from point A to point B to point C? And how do we do that in a tax-efficient, tax-smart way? So we've got different perspectives here. I actually hope there's some disagreement on different things, because I kind of live for that. It'd be kind of fun. So some questions these folks may have heard in advance, and there's going to be a bunch I'm going to throw at them which they haven't heard in advance, which will be fun also. So I'm going to start with just the last few days. Any thoughts on the last few days? And I'll start it down this end.
The microphone. Go ahead, the microphone.
There you go. Great, thank you. So
Last few days have been quite exciting, and our perspective is that it's been a bit of a snowball effect. That right up until late September, we had a market that was making another all-time high. And sometimes when that happens, you get this investor behavior that doesn't want to miss out on the next rally, and it feeds more money coming into the market, and the market continues to make new highs, kind of like what we saw through 2017. There was a prospect of that happening again. Then all of a sudden, we got an announcement by the Fed chair, Jay Powell, not only that he was going to raise rates again, but that he was likely to raise rates at the end of this year, 3 more times next year, and we were nowhere near the level he wants to get to. And that last part was the one difference from all his previous messages. That was more hawkish than what the market expected. So that sent an alarm into the bond market. So this is where the snowball comes in. So then the bond market reacts, rates go higher. There are certain levels that anytime rates got to those levels, they come back down again. Well, now they finally broke through those levels. They broke a downtrend that was going on for many, many, many years. So this alarmed people. And then on the equity side, people thought, well, maybe it's time to take some profits. We've done so well with US equities. US equities have so outperformed the rest of the world that maybe it's time to take profits, especially where the biggest profits were, and those are the technology stocks. So we saw the technology stocks first come down, and then we saw the market start to snowball. So we think it's this cascading effect, and now it's feeding on itself because as the snowball started, you've got what they call risk parity funds, you've got computer-generated funds, which have certain rules, and when the volatility level goes up, they are required to sell. And so the volatility goes up when the market starts to come down. Now they're required to sell. That causes more volatility. There's more selling. And that would be my best explanation for the last few days.
I don't disagree with anything said. I guess I would say in terms of GMO's perspective, and I think it was laid out quite well in the beginning, if something's been doing awfully well, there's a good chance that we think it's too expensive and we don't want to be near it. If something has not been doing so well, there's a good chance we still think there's good value there. And some of the things that you were describing sound very much to me like the top of a bubble, a euphoria type scenario when things get quite risky. We've been awfully cautious about the US for a while. It has done tremendously well. The fundamentals are sound. I wouldn't disagree with that. But the type of price move we've seen for perfectly sound fundamentals is far in excess of what we think is reasonable. So some re-rating and some repricing is welcome. We think there's a ton more repricing to come in the US equity market. That said, overnight, Asia sold off quite a lot as well, and we think there's still quite a lot of good value in emerging markets, and a fair amount of bad news has already been priced in. So I guess our perspective on US is it was well-deserved correction.
So I don't disagree with any Catherine's or Steve's comments. For those of you who were here last year, I think I suggested that you stop watching CNBC. I would stop watching CNBC, particularly in a week like this, because I think it just creates the wrong kind of emotions for making good long-term decisions. So that's something I want to throw out there. I would also say, and just maybe to build on to Steve's comments, we've obviously had this mini downdraft that we've seen for a couple of days here, and that feels unusual given sort of what we've experienced over the last few years. But I think our perspective is that the markets are actually more fragile, not less fragile today than they were a decade ago or 15 years ago or 20 years ago. Part of that is the unintended consequences of Dodd-Frank, where you have less capital from the large money center banks that's deployed in the markets to make markets in various types of securities. So you are going to have periods of time in fixed income markets in particular where interest rates move a lot or spreads move a lot, and that will surprise other parts of the global markets, whether it be the domestic stock market or the overseas stock market. So in small spaces of time, you will have greater periods of surprise, if you like, in markets where they might drop several hundred basis points more than they would have dropped in the past. And it sounds sort of superficial to say stop watching CNBC, but I think you just have to accept that we can be in a a more volatile environment in those periods of time. And perhaps the best approach is not to react to it and just to stay with your longer term asset allocation and not overreact to market gyrations.
Thank you. Pretty, oh, here we go. It's working. Yeah, tough to disagree with the prior three here. Steve gave great commentary as to what probably happened. I don't know what tomorrow's forecast is. I don't know what global investors, how they'll react to it. I do believe that perhaps along the lines of GMO, I think valuations, I think at the beginning of every day that there's a predisposition. And if valuations are high, I think there's a predisposition that'll take news in a most negative way to beat it up. I think valuations are low, the opposite happens. Really quite unpredictable. You know, I don't want to, you know, I know there's some pain out there, people get nervous. You know, you got to keep your eye on the horizon. I think there's a lot of, have faith in math. I think it'll eventually prevail. Maybe a little good news today, emerging markets only lost half as much as the S&P. So, anyways, not to be flipped.
Okay, so I'm going to go rapid fire. I'm going to start top down and move up and down the list. I'll start this way. We'll do this sort of thing. Because we got to make it interesting, Glenn. I'm going to have you guys thinking your feet. Can't give you all the answers, right? Come on, there's no curve here. So let's talk about tariffs. Anyone that wants to, Greg spoke of tariffs. Is there anything to worry about, or is it just, should we think about it when we're building our portfolios, and what do we do or not do? And everyone doesn't have to have a comment. Whoever has a comment, please feel free. Okay. Pass it down.
Do you want to?
Yes.
Okay, I'll start. I'll be quick. I think the biggest issue with tariffs is they're a bigger deal for emerging markets and overseas equities than they are for U.S. equities. Here they're an impediment. They get in the way of normal business decisions. I went shopping for a bicycle a few days ago, and the bike owner told me, buy it now because the price is going up in January. And you think about that, why would the price go up in January? The answer was because of sanctions on an imported bike. That seems just a crazy way to do business to me. The portion of trade that represents GDP for the U.S. economy is much smaller than overseas. It's a much bigger deal for China. It's a much bigger deal for the European Union. So when we threaten sanctions and have these kind of trade spats, it's much more impactful for other parts of the world. So you might say, well, why are we doing it? Well, you know, there are lots of inequities in trade relationships that we have. That's a fact. But it's a fact that's been arrived at after decades, if not hundreds of years, of global trade relations between these countries, and we've arrived at that through negotiations over a long period of time. The reality is, though, I think if you, just trying to sort of throw, having these kind of negotiations in the open air in the way that we have been doing is harmful to business activity. We've been beating up on our allies. Canada, for example, or the European Union. It doesn't make a lot of sense. This undermines confidence from a global macro perspective. And then if you talk to business owners, I'm sure many of you are business owners, if you import anything, or if you have to export, if you have to deal with the new bureaucracy that's been created by the trade sanctions, it's not helpful. So we're really getting in the way of normal business activity progressing, particularly in this, certainly for manufacturers and other companies in this country. But as far as markets go, it's a much bigger deal for companies overseas, and particularly emerging markets, and particularly for China.
As a general point on tariffs, we would say tariffs are definitely not good for assets. So tariffs can lead to inflation, as just acknowledged, which is not good for bonds or for stocks, and they can impede growth, which is not good for stocks at all. In terms of, is it much worse for US versus emerging markets? I think there's a bit of a fine line there. I certainly agree that for export-driven economies outside the US, this is definitely not a good thing. Of course, the US is in the unique position that though we're a relatively closed economy, we are having skirmishes with many of our trade partners, whereas each of our trade partners is only having skirmishes with us right now. So we are in a position where we're going after many trade partners as opposed to each of them, it's only really about their trade with the United States that is impacted. In terms of our broad market views, what we like and don't like from valuation, when we crunch the numbers and we think about what the final impact on inflation is going to be, et cetera, it's small. It's maybe 1/4 of a point or 1/3 of a point of inflation based on all announced and threatened tariffs right now. So it's not a massive impact, and it doesn't change any of our relative views at all. So while I think it's generally not good for assets, and I agree, not great for policy, it's not really impacting GMO's global market views.
When I think of the tariff situation and trade situation, I think in two parallel tracks. And I think there's a strategy that's very different on track one than track two. Track one is all the other countries out there except China, and track two is China. I think our strategy with track one, with all the other countries, is to use our power and our leverage and to have a view that maybe we've been taken advantage of, we haven't been tough enough, we've got unfair practices, and to threaten tariffs with the hope that they go away. So I think the goal would be not that we end up with tariffs, but that we use our tough negotiating position, and at the end of a long series of negotiations, we'd get a more fair deal and the tariffs would actually go away, and ultimately it would be a good thing. Now, we all know that all the best intentions don't always result in an answer, and sometimes wars, whether they be real wars or trade wars, start by accident. Someone has the right intent, no one wants to get in the war, and then you end up in a tit for tat and things go bad. But I do think the idea with the tariffs is just to use it as negotiating leverage to do away with tariffs. So that's good. Now with China, I think we've got a whole different situation. I see from a big picture historical perspective, you got the dominant country in the world, the US, and you've got China, which is the ascending power. And some people don't realize that for most of civilized history until the early 1800s, China was the biggest economy in the world. And then they fell off dramatically in the early 1800s, and now they're just starting to come back, and they want their place again. And in history, whenever you have a dominant power, and you've got an ascending power, you've got a natural conflict building. So I think with China, it's not just about tariffs. I think we're in the very early stage of what you might call an economic Cold War. And I think there are certain forces in the administration that say, if we're not careful, China's going to be the dominant economy in the world. That means they'll have the dominant military. We better act in a way to not let it be so easy for them to outgrow us. So I think with China, it's a whole different situation. Now, in terms of its impact on the markets, it is true that we export a lot less and import a lot more than a lot of other countries. So the first order effect is a lot less for us than the rest of the world. However, if the impact is that world trade slows down, China has become a much bigger part of the global economy. The emerging markets have become a much bigger part. And if all of global trade slows down, on a second order basis, it will eventually come back to us. You can't, it's not a zero-sum game where if you hurt someone else, you build yourself up, maybe temporarily, but eventually the whole world could suffer. But that's down the road.
Thank you. Stay there. We're going to jump to another, a short one, or a fast one.
It's really short. I mean, you're touching on the fact of the New York Times article, the same thing, where the world comes together and faces down China's infringement on patent and intellectual property. And that's really what you're touching on, Steve?
So if the U.S. is successful in negotiating settlements with the rest of the world other than China, then that's an opportunity to bind together as a group, and it could be much more powerful leverage against China in any unfair practices.
So we're going to jump to interest rates. So last year we had Jeff Kleintop was here from Schwab, and he had I'll say kind of a simplistic view to find the next recession, right? The yield curve, the difference between the 10-year Treasury and 3-year Treasury. If it inverts, it predicts the next recession, right? And that was his central thesis. We haven't inverted yet, I don't believe. Okay, we're close, and it could sit there for a long time. Who knows? I guess one, do you really think that is a predictor? A. B, will the Fed succumb to pressures from the White House to be more benevolent from their perspective?
All right. We've spent over the years an enormous amount of research analyzing the impact of yield curves and their slopes and how fast they change and the impact on the markets and the economy. The first paper that was written about the importance of yield curves was written in 1898 by a guy named Knut Wicksell, and you can still get that paper on the internet, last time I checked. Almost every business cycle that's happened in the last century, not all, but almost all, has been preceded by what they call an inverted yield curve, when short-term rates are higher than long-term rates. However, every time the yield curve starts to invert, you'll see articles in the media, the Wall Street Journal and other papers. It happened in 2000, happened in 2007, it's happening this year, where pundits get up and say, well, this time is different. The yield curve doesn't matter. And the reason is that when the yield curve inverts, it's not an instant effect. There's a time delay of several months before it really takes effect. So every cycle, the yield curve starts to invert. The economy's still doing well. The market might still be doing well if other things are going well. Everyone says it doesn't matter anymore. And then a few months later, slam. It happened in 2000, happened in 2007, 2008, and it could happen now. Now, as Mike mentioned, yield curves aren't inverted yet. And if you go back to the late 90s, they got quite flat, almost inverted, and stayed that way for 5 years. And what happened in the last 5 years, the 1990s? The market went ballistic. So until the yield curve inverts, does not necessarily mean we'll have a recession. Other things could cause a recession. Now, some people ask, why does the yield curve matter? Why does it matter if short-term rates are higher than long-term rates? Some people say, well, it's just a correlation. Maybe it doesn't really have any causal effect. And what we think is it has a very strong causal effect, that one way to kill an economy is to stop lending. And one way to stop lending is to discourage banks from lending, the banking system. Banks make their money by lending long-term and borrowing short-term. So what happens when you raise short-term rates and you lower long-term rates in relation to short-term rates? You have no more profit margin to make, so you're not incented to lend. And that's really the mechanism that happens.
Just to give disclosure, at GMO we don't try to predict recessions. We don't try to predict anything economic. We just try to predict asset class returns, which is probably a difference. So we're actually not looking to predict a recession, and we're not particular, recession forecasters. But the one thing that has been bothering us lately about the possible inversion of the yield curve is that we feel that not enough people have been claiming this time is different. And we worry if people aren't claiming this time is different, it might not work the way it's supposed to as a signal. So in the late 1990s, everybody was saying it was because of the 30-year Treasury stopping. And then in the 2007 time period, it was all about the foreign savings glut. And so this time it was different then. And I guess there's maybe a smattering of things are different with, the pension funds doing LDI, or there's a hint. But the one thing we've been wringing our hands about is, aren't people usually saying this time is different, and aren't they usually completely wrong? Well, if they're not saying it, maybe the signal's not completely wrong, but anyway.
So I agree with most of what's just been said. I think our perspective would be, back to Steve's points, every recession has had an inverted yield curve, but every flat yield curve hasn't resulted in a recession. So, we have a relatively flat yield curve. We could grow for years to come, or not. And just looking at sort of the shape of the yield curve as it is today doesn't tell you which way we're necessarily going to go. And I guess I would go back to Steve's comments. Why do we actually get a recession when we get a flat yield curve? Because the Fed has intentionally pushed up the cost of economic activity through interest rates so that we effectively slow the economy. So I think there were comments earlier from Greg about sort of 4.2, 4.1% growth. You can ask about sort of growth in GDP, but it seems to us that if the Fed's on a tightening cycle, and they have been for some time now and will continue, assuming that they're not influenced by the president, which I don't expect that they will be, the economic growth should slow in 2019. Perhaps we've seen the peak measures of GDP growth in this cycle, and that next year it'll be slower. I don't know what the number would be, but there's no reason why it shouldn't be slower next year. That's what the Fed is essentially trying to do by pushing up short-term interest rates. They're trying to constrain the economy, slow economic activity, so there's less price pressure, so we don't have the threat of inflation. So to move, if all of what I just laid out even is close to being correct, where are we as far as interest rates goes? We've heard this sort of steady drumbeat for maybe 15 years now that rates are going higher. And usually that comment is made about further out on the yield curve. We're now at around about 3.25% on the 10-year Treasury. Municipals, not too much different than that, but a little inside of that for that part of the municipal yield curve. We at Rocaton don't see necessarily that interest rates go an awful lot higher further out on the yield curve from here. And the simple reason for that is, you see, I think we've all started off to this part of the session by talking about what's happened in the last couple of days. And I think Steve pointed to the interest rate move upwards that spooked the stock market. So if you're in an environment where you actually expect that interest rates further out on the yield curve are going to move up meaningfully, the stock market's probably going to need to be a lot lower than where it is. And if the stock market goes a lot lower, that's going to suppress economic activity, bring interest rates back down. So there's this complex dynamic, maybe it's not that complex, but there's this dynamic between interest rates and the stock market and economic activity, which is sort of, in our view, maybe put a ceiling on interest rates. And in contrast to what I think many of you have heard for many years now, we don't see longer term interest rates going up because of this ceiling effect, and because, frankly, there's so much more debt in the world. You heard Greg talk about the amount of government debt that's in existence today and how much it's increasing each year. If you look at the amount of debt globally held by individuals, corporations, governments, municipalities, globally across the world, it's far in excess of where it was in 2008 when we had a credit crisis, because apparently we had too much debt and the wrong kind of debt at that point. So just bear that in mind. We think that sort of keeps a lid on interest rates and perhaps stops interest rates from moving materially higher. And just to finish on the point about I think it is quite worrying that the president is so vocal in criticizing the Federal Reserve, because perhaps in response to the market volatility of the last couple of days, they might have softened their statements about next year on their own, as Janet Yellen's Fed did multiple times, if we go back several years. But the fact that the president says it's crazy what they're doing means that the Fed has to stand up for the institution of the Fed and say, we're going to have to stay hawkish at this point. So unfortunately, in this situation, we get perhaps the opposite of what we might have wanted, certainly as stock market investors. But if we had a real downturn, you're still going to have a hawkish Fed, because they have to protect now the institution and the perception that the U.S. Federal Reserve is independent of our political process.
Okay, tough act to follow here. I'll be a lot more simplistic. Yeah, in terms of, so what are the practical implications? I mean, what my fellow panelists have said all sounds logical to myself. Forecasting interest rates, pretty difficult to do. What are the practical implications? So you pick your spot on the yield curve, you look at risk and reward, and when you're looking at that 2-year treasuries paying almost as much as 10-year treasury and knowing there's a lot more duration risk with the 10-year, maybe it makes more sense to dial it back and manage risk. Obviously, and even if there is a recession, the recession, the economy, politics, and the markets or individual stocks are not all synonymous, and then they don't all time perfectly. The markets, equity markets, supposed to be forward-looking. So very difficult to kind of filter through that. But again, you just kind of let's pragmatically step back, take a look at it, and make a nice logical decision, and understand whatever you're doing in the equity fixed income markets, it should all kind of work together in some fashion. Yes, Mike, give me a tax question, buddy. This is outside my league.
I'll get you in a few minutes. I'm getting more granular as we go. So I'm going to jump one more big picture before we get more granular. And in finance, I always hear the most difficult thing to do, the brain surgery or the rocket science, is predicting currency movement. So currency movement's a big deal, right? If you're a U.S. company exporting, the direction of the currency matters a lot in terms of your exports potentially. If you're an investor in foreign markets, and if the currency is moving in the wrong directions as it has for a while, it'll hurt your returns and the like. Do you hedge for it, not hedge for it? So there's a lot of repercussions. And even when we think about investing in international and emerging markets, the trump card to the whole thing is I was told not to use that word today. The ace in the hole is whether when you look at this you can make money and still lose money by the time you bring it back into U.S. dollars. Is a concern question. So any thoughts on currency movement of the U.S. dollar relative to other currencies?
Yeah, I got the mic. I'll talk for a minute here. My rudimentary understanding is that I don't know anyone who's been really talented in forecasting currencies. If someone knows someone who's really had some, okay, there we go. There you go. So we'll get to number 3 here in a second. In any case, my rudimentary understanding basically can hedge out currencies on the fixed income side. It's not practical on the equity side. And here we are at a very interesting point in history in terms of, and I'm very much in the valuation camp. I'm in the, nothing's going to help you in the short term in terms of predicting, and the only thing that helps you in the long term is paying attention to valuations. And if you look at the valuations today, it's really screaming international. And in any case, if you pragmatically look back, if you came from another planet and looked at the globe as we see it, it would make a screaming international buy would be the sign. But the problem there is you're going to blow on the wind with currency. And what's caused international to underperform this year relative to U.S.? Well, maybe the headlines is trade war, but the actuality is the currency moves. So whether that levels out over time or not, I'll love to get some reflections on Rokaton and other folks here. But in any case, I think it's a fact of life that you probably live with it and keep your eye on the horizon.
So I love currencies. They're fascinating because it seems perfectly obvious what should happen with them, and then the opposite happens. And so, from the perspective of somebody who meets investment managers and evaluates them and recommends their strategies, a long, long time ago, I made the mistake of recommending currency managers who attempted to make money just by trading in and out of currency. And it was a disaster. They all lost money, and like all of them. In fact, I've sort of came to the view that if you collected a group of 5-year-olds and sat them on the floor in front of you and asked each one of them whether the dollar was going up or down, you'd probably have better results than if you hired currency managers to make those decisions for you. It's bizarre how wrong they are, and it's bizarre how the models that look at currencies and think about them carefully, I'm sure GMO's models in particular, are completely intuitive. They make all the sense in the world, and then they're so wrong so often. Not yours, but everybody else's. And it's just it's surprising. So for example, 2 great examples are last year and this year. So last year, the dollar was supposed to strengthen. All of the metrics said that the dollar should strengthen. It didn't. It weakened. And so coming into this year, everybody expected the trend to continue, and the opposite happened, which was exactly what people expected the previous year. It's just that it didn't happen the previous year. And so lots of people got whipsawed in one direction or the other, and just sort of these currency moves. So we tend to leave currency alone. We don't try and make money in currency. We still have not found, we're not even try to look for people who can successfully sort of predict where currencies go. Typically our overseas holdings are unhedged. So, you know, it's very difficult to predict where it goes from here. I'm guessing you want some comment on where the dollar is going to go, though.
I do. I was getting there, but thank
So,
Anybody got a coin out here?
So the dollar's been obviously strengthening this year. It's a lot stronger today than it was 5 years ago, and you know, I think there's some good reasons for that. Our growth has been much better than overseas growth. The U.S. has much deeper financial markets, much larger economy, great sort of venture capital, small cap, economic financial ecosystem within the country versus other regions. Lots of reasons why the U.S. on a relative basis, the value of our economic output should have risen versus overseas. Just currency trends don't tend to keep on going. They do for a period of time and then they end and they reverse. So at some point in time, I don't know, I'm not smart enough to figure out where the point is. Overseas currencies now, not uniformly, but have greater value today than they did 12 months ago, 5 years ago. There are more reasons today why the dollar should fall over the next 12 months. That's not a prediction, I'm just saying there's more reasons why it should fall. Over the next 12 months, 2 years, 3 years, 4 years going out in the future. If we get continued surprises in growth on the positive side in the US versus overseas, and if other things such as interest rates continue to favor US or flows to the US, the dollar could continue to be strong, but the majority of the forces are suggesting that the dollar is expensive here and should weaken over time.
I guess I'll disagree with the two gentlemen
You became one of my favorites
in the sense that I do believe that currencies are forecastable, but I will add a caveat that gives some credit to what they said in the sense that we don't think we can forecast them on the short term. We only think we can forecast over the long term. And that's true for every asset we forecast. We forecast some 70 asset classes each month and every major currency. And the key is we're creating 7-year forecasts. And the reason we create 7-year forecasts is because our main signal for forecasting is valuation, and valuation takes a long time to work. So we don't think we can figure out what's going to happen through the end of the year in any asset, but our predictions of what's going to happen over the longer horizon because of valuation have been very accurate, including in currencies. In our portfolios, we've added a lot of value through currency management historically. One key to that I would say is we don't run a single strategy that's pure currency management. It is included with other things. So sometimes, for example, shorting Australian dollars is a hedge for equities, for example, but it has really added value over time. And our models say that the dollar is expensive today. It's not wildly expensive. It's 0.8 to 1 standard deviation expensive. And valuation starts really pulling at currencies when I'd say they're greater than 1.5 standard deviations expensive. So it's not so expensive that I think valuation is a huge anchor or a huge gravitational force on the dollar at this point. But we would say expensive, and you're better off carrying your foreign currency exposure today, not hedging your developed ex-US equities, definitely not hedging your emerging market equities, because that would cost you so much money to begin with that you're starting out in the hole. And we have decided to selectively hedge equity markets in the past, and our decisions with respect to selectively hedging on rare occasions have been pretty good.
So currencies have a very important effect on equity markets, on bond markets around the world. So it's really important to understand how currency movements drive and change markets, as well as trying to forecast currencies. And to give a simple example, the dollar was very strong in the 2013, 14, 15 timeframe. And emerging market equities as an asset class looked attractive because they, by many measures, are very undervalued. But they just kept getting even more undervalued because the dollar was strong. When the dollar strengthens, emerging markets suffer because they have a lot of dollar-based debt that they have to pay. As their currencies weaken against the dollar, it's a lot more expensive for them to pay those debts, and they start to contract. It wasn't until early in 2016 when, after one rate hike, Janet Yellen said, oh, this must have been a mistake. We're going to blink. We caused a lot of instability in the stock market in early 2016. The market fell over 10%. And she said, forget about those rate hikes I talked about. We're going to pull back. And immediately, when the Fed policy changed, the dollar changed. It came right down. And as soon as the dollar came down, all of a sudden, emerging markets were very attractive. Not only were they undervalued, but now they had the catalyst to start to appreciate. And that's when we got much more fully invested emerging markets. All through 2017, the dollar stayed weak. Emerging markets did very, very well. And then in the first quarter of this year, we took all our profits in emerging markets. Even though you could argue they were still undervalued by certain metrics, the dollar started to strengthen again. And why was that? It was because unlike the global synchronized recovery we all heard about and observed in 2017, all of a sudden there was a major divergence. Our Federal Reserve Board was the only major central bank continuing to raise rates in a steady way. Europe was holding off. They said, we're not going to raise rates for a long time. Japan was holding off. They said they're not going to raise rates for a whole time. And the dollar surprised a lot of people and started to strengthen. And so we took our profits in emerging markets. We've been negative on emerging markets since March. But if, for some reason, the Fed were to decide that they're not going to stick to their plan to do another rate hike in December and 3 more in 2019, but if they make a less hawkish statement or they somehow pull back, we would expect the dollar to react negatively, and that could be an excellent entry point into emerging markets again. And one comment, just to back up what David said and what Greg said earlier about President's comments on the Fed. It's considered very unusual and really inappropriate for a president to comment about the Fed because the Fed is supposed to stay really independent. My guess is that he's not trying to influence the Fed. He doesn't really believe that the Fed shouldn't be raising rates. He's just looking for a scapegoat so that if the market goes down, he could say, look, I did everything I could, but the Fed killed the stock market. Don't blame me, blame the Fed. I think he's laying out that strategy.
That's with you. So I'll go one more step granular. And so we see a difference in views here. And so I want to go down to the asset class level and how you select asset classes, what you do, and each of you do. Favorite asset classes, least favorite asset classes. And I know it's a portfolio we're building. But I just want to get some views. And I think you're going to hear different ways of thinking about this. And Glenn calls this career risk, this statement I'm making here right now, because you're going to hear some very different perspectives, right? And I'm looking forward to hearing that.
So in terms of our allocation, we've been pulling back more recently and reducing some risk. Based on our analysis of the U.S. stock market, while it's very true that the economy is very strong, corporate earnings are very strong, we're likely to have great corporate earnings coming out in the next few days. It's also true that the U.S. stock market has greatly outperformed all the other markets, and a lot of that good news is already priced in. Now, we don't believe that the U.S. market is quite as extremely overvalued as others. There are some metrics that suggest it is. You look at price to earnings ratios that go back 10 years, and we're as overvalued as we were back in the bubble of 2000 and back in the Great Depression, in 1929, right before the Great Depression. If you adjust those kind of ratios or other valuation ratios for the cost of capital interest rates have been so low compared to norms that can justify some of that extra valuation. So we do think that U.S. stocks have become a bit overvalued, certainly in the technology area. But when we analyze the different factors, the economic factors, the way we look at it, have turned quite neutral. The yield curve hasn't inverted yet, but it's flattened a lot. Not really bullish for equities or bearish. Credit spreads, the difference between a yield on, say, junk bonds or low-quality credits and high-quality credits, are at all-time historic lows, so very close to all-time historic lows. Not a lot of room for improvement there. If the credit spreads start to widen, there's some serious risk that you'll see valuations or prices come down again. So we see the idea that U.S. markets would go up a lot from here was becoming totally dependent on investor behavior. people wanting to throw money at the market because they have a fear of missing out. They don't want to miss the next rally. Everyone else is having a good time making money in the US. And we got it to new highs in September. And if we stayed at new highs and we continue to make new highs, I think there was a chance that the market could have done what they call a market melt-up, which happens sometimes at the very end of a bull market, like it happened in 1999, early 2000. You get a market melt-up, it's psychologically driven. There was still a chance that that could have happened. Now with this turbulence, there's less of a chance. And when we look at the other factors, US markets are not nearly as compelling. We're not completely out of the US equities, but we've pulled back our allocation quite a bit. In terms of international equities, we've been neutral to negative on Europe. In Europe, the yield curves have been very, very flat. There's not a lot of growth there. They've improved a little bit. But there are other problems with populism in Europe and the threat of Italy and bond yields starting to climb there. We don't think Europe is particularly attractive. Even though on a valuation basis you can say it's relatively undervalued, we don't think the catalysts are there yet for Europe to begin to climb. We think Japan is kind of interesting. Japan has flown under the radar screen because their stock market peaked in December of 1989. It was at 38,900. And here we are almost 30 years later, and it's only around 22,000. So Japan has had decades of very mediocre performance. People have kind of given up on Japan. And yet lately, the Japanese economy has been growing better than expected. Corporate earnings have been better than expected. And they haven't got that kind of credit, but more recently, until the last few days, Japanese stock market started to pick up. And the other thing is that the cost of capital in Japan is extraordinarily low. The 10-year bond yield in Japan is 0.1%. And so why not take a look at Japanese stocks that have a dividend yield of close to 2%, earnings growth that's quite substantial in the 9% range, and the cost of capital is just above zero. So Japan is kind of interesting. And then with emerging markets, we think there's a lot of value being built up in emerging markets that relative to other markets, they look quite attractive. But we would wait till the catalyst is present, the falling dollar or other catalysts that might say now is a good time to enter. That could happen very soon. It could happen further down the road. In our opinion, a lot depends on the Fed and some of the other central banks. In terms of fixed income, we have been quite concerned about duration risk. And as David pointed out earlier, or no, maybe it was you, that you don't get paid a lot more to be on the long end of the curve as a short end, and you have a lot more duration risk. If interest rates go up, your principal value of your bonds can actually lose money on the long end. Now, we've had the biggest bull market in bonds in the history of civilization that started in September of 1981, and it ended worldwide in July of 2016. And that's unlikely to be repeated because there's just not enough interest rate points to go down from there. And so we think it's likely that we've now begun a very long cycle of rising rates. It doesn't happen all in one straight line. There'll be fits and starts. There are some impediments for the interest rates to rise more quickly, and one of them is the strong dollar, because that does attract some capital. But we think, generally speaking, yields are going to climb higher. A lot of the debt problems might not actually restrain rates, but might be reasons why rates go higher, because if you're an investor and you're more worried about who you're lending money to, and they're becoming less and less disciplined with their budget, and they're creating more and more debt, aren't you going to demand a higher rate of interest to lend that money? And they call that class of investors the bond vigilantes. In the 1970s, even though we had a recession, interest rates went up, not down, because people were worried about inflation, and the bond vigilantes required higher and higher rates. That's not what's happening now, but it could happen if inflation surprises to the upside. And then with hard assets, there are times when the best way to hedge against the equities coming down is to go into bonds. But that doesn't always work. Sometimes, like in the 1970s, equities and bonds both do badly, and you have nowhere to turn if that's your whole investment universe. There are other times when the currency weakens, when there's a lot of geopolitical uncertainty, when inflation starts to rise, when hard assets can be an excellent hedge. By hard assets, it might be having some gold in your portfolio or some commodities. They generally don't do as well as the financial assets over long periods of time. But in certain instances, they can really help offset losses in the stocks and the bonds. And then finally, another asset class that people forget about is cash, or very short-term fixed income. And up until, for 10 years, that's been not a great place to be because the yield you get has been very, very low and the markets have been going up. But for the first time in a long time, interest rates on cash equivalents are for a duration of a year or slightly less, and now over 2.5%, getting closer to 3%, better than dividend yields. So we don't think that's a bad place to have some of your assets.
Well, at GMO, we look at all assets through the lens of valuation. As I mentioned, we publish a series of 7-year asset class forecasts, and they're updated every month. So all of my views are valuation based. And starting with not liked assets, our most hated asset today is U.S. stocks. And it's simply because they're so expensive. It's not a view on the U.S. economy. It's just a view that the prices are far in excess of what fundamentals justify. And in our portfolio, we have 0 weight in U.S. equities, which is pretty dramatic. And this is not... Yep, go anywhere, benchmark-free strategy, no U.S. equities. We did sell out of those earlier this year. And you know, I do acknowledge that there could be some final last melt up. In fact, some of the statistical signals we use to look for bubbles, which we do love bubbles at GMO, are kind of flagging a bubble for US stocks. And part of flagging a bubble means you could expect a euphoria. Typically what happens in a bubble is you get this last euphoria. But we never try to catch that last little top up. Our approach is much more conservative. When something's looking really expensive, we just avoid it. We got completely out of Japanese equities in the 1980s. We got pretty much completely out of all technology, media, telecom stocks in the 1990s. And we pretty much backed our way out of all stocks leading into 2008. We maintained about 25% exposure to only US high quality stocks in our portfolio. So we'll take pretty extreme moves, and we are now all the way out of US equities. In terms of favorite assets, number one, emerging markets value stocks are 7-year real return forecast, so forecast above and beyond inflation for that asset is 6.6% real. It is by far our favorite asset class compared to anything else today. There's a very wide margin between that and our next best expected return asset. Our second favorite asset, I guess I would say, is developed ex-US stocks. We agree there's some interesting things in Japan, and particularly value stocks. Emerging markets value and developed ex-US value. In every region globally, value spreads are at historic wides, either 80th or 90th percentile. And then for a third favorite asset, I would pick liquid, low volatility alternative strategies. It's 30% of our benchmark-free portfolio today. Historically, it has not been a large position in our benchmark-free portfolio, but in a situation where both, as you mentioned, interest rates and discount rates could rise and stocks and bonds could sell off in tandem, we like the idea of being in strategies that are taking a lot less duration exposure and a lot less directional market exposure. So if there were a surprise, say inflation surprises to the upside, if you acknowledge this part of the portfolio would be much less impacted by such a broad market repricing. We've never taken such a high position in alternative strategies before. We have 7 different strategies in our portfolio. A number of them take advantage of relative value positions, and it's a great time to be taking advantage of relative value positions because while our valuation-based forecasts are muted today, forecasts across the board are kind of low, the spreads between our equity forecasts are at all-time wides. So the spread between our US and emerging markets forecast is over 90th percentile. The spread between our US and our international forecast is 99th percentile. The spread between growth and value, as I said, is 80th to 90th percentile, depending on where you're looking. So we've got 2 equity relative value positions. We've got a relative value rates and FX strategy. We've got a merger arbitrage strategy, put selling strategy, kind of special opportunities, flexible go anywhere strategy, systematic global macro strategy. So that's what we're doing.
Well, I spend a large part of my time researching private alternative investment strategies, and I have to say I believe strongly that I can find much better risk return in that part of the world than I can in publicly traded asset classes. So that's my first dodge. I won't dodge again.
You can pick that as your favorite asset.
The
That
favorite.
asset class typically requires a qualified purchaser
Yep.
with over $5 million investable.
Yes, that's true. But back to public markets, and if you have a long time frame in mind, and that's not 1 year, 2 years, it's longer than that, I agree with the comments of Steve and Catherine about emerging market equities. And particularly, I would point to the comment that Steve made about the dollar stabilizing and not rising anymore is giving a signal for maybe an inflection point in the performance of emerging market equities. Beyond that, I think all asset classes beyond that, and to lesser degrees, are not priced particularly attractively. I would agree with Catherine as far as U.S. equities. Non-U.S. equities are not as unattractive, but to Steve's comment, I think there's some real strong headwinds getting in the way of European stocks performing better. They have a very unpleasant sort of macro picture to deal with, political picture to deal with at the moment, but they are cheap. So I think if you take a long-term view of equities and try and ask the question, what really moves prices over the very long term, it's valuation. So we think that there's some chance that you would get attractive returns from being overseas versus being in U.S. markets, and we already talked about sort of the trajectory of the dollar over the next few years.
Glenn, do you want to toggle your conversation to the behavioral finance aspect of some of these different asset classes?
First, a few comments. So anyway, I couldn't help, these issues are right on. So as far as Steve's referencing a catalyst, and maybe David is as well, my fear is once that catalyst happens, are you too late? Or the equity market's going to move so quickly that you're on the sidelines. I go back to, so the emerging markets piece is particularly acute, and to some earlier commentary, the valuation spread is really quite historically almost unprecedented. Somewhat facetious earlier about only losing half as much today. In any case, on the U.S. equity side, I don't think anyone's going to flicker the lights, before the party's over. So I think trying to time that is also very difficult. Mike referenced career risk. So honestly, if you open up the Globe today, the New York Times, Wall Street Journal, almost all the articles are about just one market, ours. It's as though the rest of the globe did not exist. So as investment advisors, wealth managers, to the extent you deviate from this preconceived expectation of the S&P, ripe but early is a kiss of death. So I go back to GMO, 1999, did a 10-year forecast, and they forecast that U.S. equities are going to lose 2% over the next 10 years. And at that point in time, emerging markets, some others are much higher. And they lost a lot of business the first 2 years. But boy, were they incredibly right. Right but early is the kiss of death. So there's a lot of career risk. So folks need to be patient. And
I was getting the kiss of this story.
so it's problematic. So I honestly think this is a very significant conflict of interest of every investment committee in the country is kind of dealing with this expectation from clients of the S&P. And if you deviate from it, will there be patience or not? So I plead for patience. Anyway, so in the behavioral piece, I think that's part of what got me going here, is there's this, everyone wants to beat something. And the most likely thing you want to beat is what's in the paper again, the S&P. So, the truth is, if you're going to be diversified, kind of by definition, you're always going to have an asset class within your diversified portfolio that's going to outperform the diversified portfolio. It's always going to be one. Where it's problematic is when that one is, in fact, the S&P what everyone's expecting. So, honestly, I think we've taken the high road on that line. But, sorry.
So I'm going to turn it over to you folks. I kind of went off script. Sorry for going off script. I kind of was thinking as I was going, and I heard Greg's comments, so I thought we covered a lot, and it was a lot of fun. So I want to turn it over to you folks with questions that you may have. Jody?
I just want to know why I didn't have this meeting last Friday.
Is that it?
That would save me a lot of money.
questions for Professor Frank. Just wondering what your thoughts are regarding having to take the tax hit on selling a profitable position to re-asset allocate.
All right, so very practical question. So we're suggesting, and it doesn't sound like I'm alone, that maybe people should ease up on U.S. equities, and that probably means paying a cut in a big check. And that big check next April is incredibly real. And this is all forecasting and speculation, et cetera, on our part. So it's a function of doing the math. If in fact we look at Rocaton numbers, and by the way, in terms of GMOs, not alone. If you look at GMO, Rocaton, Goldman Sachs, JP Morgan, other across the board, everyone forecasts emerging markets is going to do better than the U.S. So if you believe all these folks, and you do in fact sell, and you got to cut this check, that's really quite tangible. So the thought process is probably, it's a function of your expected return on U.S. equities versus international. My guess is, if you think of it this way, that the tax check's an eventuality, and a larger tax check is probably a good sign that you had a larger gain. So maybe, unless you want to give it to charity, which is not a terrible thing to do, get some tax subsidy. Yeah, I think you do some math and live with writing the tax check, which again is hopefully larger now than it would have been later.
I have a little something to add. I've actually been doing a fair amount of research on tax with respect to asset allocation because we launched a tax-managed version of our benchmark-free strategy. And we do find that our approach works even after tax. And I think the key is because we take such long horizon views that if we delay a trade for several months to turn a primarily long-term or short-term, gain into a long-term gain, we're not losing much in terms of our alpha because our alpha is so long horizon, and we're saving a ton in taxes. So we find that if you just simulate our strategy historically, yes, the difference between running a portfolio static and dynamic after tax, if you don't take into account taxes, reduces your return. But then once you take into account taxes as you're making your trading decisions, and the key thing there is just delaying portfolios so that you go from a short-term gain to a long-term gain. That's really the major insight. The dynamic strategy using valuation still adds value after tax.
I'm just going to make a quick comment following up on that, that if you are thinking about selling and you have to pay taxes, take a very careful look at the different tax slots, because the chances are you've bought securities at different times, and you might be able to pick a certain tax slot that's a long-term gain, pay a lot less in taxes than if you picked one that was a short-term gain. And I think that could be very helpful.
So I'll actually comment on that myself as a recovering CPA myself. So at Lexington, we basically look at the portfolio in its entirety, right? So we'll take a piece, the tax inefficient, and we'll hide that inside your tax deferred accounts. The more tax efficient pieces we'll hold in your taxable account. When the market pulls back like it did today, we may go into your account and sell an ETF or a position, book a loss, buy something very similar that can be used to offset other gains. So it's a very active pursuit for us along the way in everything we do with respect to harvesting losses where we can, locating assets in the appropriate place, making charitable contributions from appreciated securities. So it's all part of an overall system that we're doing. And yes, we're selling, if you will, some large cap at the top of it. But this is something we actively do day in, day out, month in, month out. That's a proven way we know we can add value. So, question, any?
Yeah, so it seems like 2018 is the year that the bill for climate change is starting to appear in various countries. And I'm wondering if you have thoughts about what do you think the impact financially, in the financial markets, is likely to be? I mean, it's all over the map, so I have no clue, but do you? Who's that directed to? Anyone, really, who has an opinion about it.
Yeah, so we don't have a forecast for climate change, unfortunately. I wish I could give you something like that. But we have actually launched a climate change fund at GMO. As it happens, the environment is something near and dear to our founder, Jeremy Grantham. And the key premise underlying our climate change fund is there are pockets where you can actually earn money from growth in areas that are either adapting to or helping to mitigate climate change. So things that are in the climate change funds, they're all public equities, are things like solar companies, wind companies. There are even things you might not expect if you were expecting it to be environmentally friendly. For example, copper miners, because copper is used in a lot of batteries that benefit. And the key thing there is a large valuation scream on top of it. So you might think, Tesla would fit in your climate change fund, but that's just too expensive for us. So we do think there is a way to make money from it if you carefully select your industries and your companies.
There are a number of vehicles that are organized specifically to address the climate change problem in a GMO. I know you have one, and your founder has been very prolific in that area. One thing I would watch is that these vehicles certainly fluctuate in price, and you might watch the price of crude oil. And the higher the price of crude oil goes, the more attractive the economics are for these companies. And so you might decide, if the price of crude oil is some people predict might get higher than $100 a barrel or beyond that, that opens up a price umbrella to make it more economic for a lot of these alternative energies. So that could be another way to think about that.
One second. I'm dropping the acronym right now. Jen, just from Rogaton, just has done quite a bit of work on ESG. So as a firm, she's hiding back there. You don't want to speak, do you? So we've actually been doing a fair amount of work in and around that and a bunch of other social issues with respect to investing. And it used to be in the old days, the adage was if a client came in and wanted a certain mandate or wanted to not be doing something, the answer was, let your investments be your investments and then do socially what you'd like to do socially. That said, today there are a number of products out there, which Rogaton's been doing research on for us, that we may be able to have our cake and eat it too. We may be able to invest and get proper diversification and yet still have your portfolio speak to things that are important to you in your life, both positive things that you like in your portfolio as well as things you don't want in your portfolio. So this is new-ish to us, and Christine Pocar, my partner, has been doing a lot of work on this with Jen from Rogaton. So more to come on that.
I feel like we didn't do a good job of answering your question, though. And I think it's really hard to say. Your question was, what's the impact on markets? I think climate change is a long-term impact. I know the day you have a hurricane, it feels like it's happening right now, and part of it is, but it's a long-term impact. So what's the long-term impact on markets is very difficult to calculate. I will say, just after my comments on currency markets and the inability of professionals to guess currency values, the market next after currency where the profession is least successful at predictions is oil prices. So I often tell the people that work for me, if anybody walks in the office and tells you they know where the price of oil is going, stop listening immediately. So it's interesting where we are today. We're at $80 a barrel. There is talk of us going over 100. We have sort of the issues that we have with Iran and cuts to supply, which might well push us over $100 a barrel. You might be surprised to hear, though, that the Saudis don't want oil to go over $100 a barrel. The Saudis have this huge oil reservoir under their country. They want to maximize the long-term value of that reservoir. The long-term value of that reservoir isn't guaranteed by them having high prices today. It's by them having a level of prices that doesn't incentivize alternative energy investment significantly over the next several years. Now, clearly, we're going to be investing in alternative energy as the next few years goes along. The Saudis are quite happy at 70, 80. They don't want 100. They don't want 110 because we're then closer to that innovation that takes crude oil out of its role today in the marketplace as a primary fuel source. And that's what they're really scared about. If you imagine that they're sitting on a huge bathtub of oil, they're trying to maximize the value of it, you want it to be used and to be used in the way that it's being used today. for as long as possible, and that's not guaranteed by high prices. So it creates some strange dynamics in the way that oil is supplied into the world. I think if you were to ask me, and this isn't a Rokaton view, this is just a personal view, what the long-term price of oil is, I think it's a lot lower than it is today. So I think we have been incentivizing massive amounts of production, both in the US and overseas in the last few years. And eventually we're going to have enough innovation in alternative energy forms where we're able to replace oil. And this vast ecosystem and infrastructure that we've created for producing oil in the world probably will be obsolete at some point, or large portions of it will be obsolete, requiring much lower prices to clear out that. Now, that could be wrong. You know, it was only a few years ago we used to hear about peak oil. Then we started to hear about peak demand for oil happening. So there's, you know, the predictions for oil are all over the place and will continue to be so. But that's, I think, is an interesting dynamic to watch as the next few years unfold.
So we're going to close the session down, and we're going to hear from Jody Mueller, my colleague, some closing comments and remarks and kind of a teaser for our next event. It'll take under 4 minutes. Can we thank our panel? Thank you very much. Really, thank you. Thank you very much. Really appreciate it. Thank you, David. Appreciate it.